What's up, everybody? My name is Dimitri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guests in this episode of Hidden Forces are Edward Chancellor, Russell Napier, and Helen Thompson. All three have appeared individually on the podcast before, and I asked them all to join me in person together ahead of our Genius Community Dinner in London for a conversation about the changing nature of the international economic and political order. Many of the material changes that we are experiencing today are driven by the reversal of multi-decade trends in demographics, globalization, and low-cost carbon-based sources of energy. The ripple effects of these changes on inflation, risk rates, wealth and income distribution, national security, and the ruling legitimacy of national governments are already starting to materialize. Learning how to navigate these changes is crucial if you want to remain ahead of the curve. And today's conversation is meant to help you do just that. In the episode's second hour, the four of us begin with a discussion about the energy transition and its geostrategic consequences for resource-rich countries like the US and Russia, for countries that are heavily dependent on energy imports like those in the European Union, and for China, which is investing enormous sums of money into renewables and other non-carbon-based sources of energy. We also discuss the possibility of a rapprochement between the US, Europe, and Russia, given the latter's vast resources, avenues for peace between the US and China, and some of the industries and sectors that are positioned to benefit, as well as those that you will want to avoid in this new economic and political paradigm. If you want access to that part of the conversation, and you're not already subscribed to Hidden Forces, you can join our premium feed and listen to the second hour of today's episode by going to hiddenforces.io/subscribe. All of our content tiers give you access to our premium feed, which you can listen to on your mobile device using your favorite podcast app, just like you're listening to this episode right now. If you want to join in on the conversation and become a member of the Hidden Forces Genius Community, which includes Q&A calls with guests, access to special research and analysis, in-person events, and dinners, you can also do that on our subscriber page. And if you still have questions, feel free to send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. And with that, please enjoy this one-of-a-kind conversation with three absolutely brilliant minds about the most consequential economic and political forces shaping our world today. Edward Chancellor, Russell Napier, and Helen Thompson, welcome to Hidden Forces. Actually, welcome back to Hidden Forces.
Thank you.
Thank you.
Thank you.
So you all know each other. I know that Russell is kind of is the hub on the spoke. He's interviewed both of you on his podcast at the Library of Mistakes. But did either of you have met before?
I don't
Helen
think so.
And Edward?
At last.
Yeah.
Yeah. But, well, I think, there's a lot of common intersections. Before we start here, as I said, or as I implied, you've both been on the show before. I'd love to start with just brief introductions. Russell, why don't you go first? Tell us a little bit about who you are and what your background is.
Sure. So my background is I'm a lawyer by training. So I have no qualifications in economics whatsoever, but I started as a fund manager in 1989, became a strategist for a stockbroking company advising fund managers in 1995. And that's what I've been doing ever since. That's my main job, writing papers, going in front of fund managers, and it's a bit like Shark Tank for your American listeners, 7 times a day, which is fun. And apart from that, I've written 2 books on financial history. I run a course in financial history called The Practical History of Financial Markets. One of our teachers is in the room, Mr. Chancellor. I'm on the board of a listed company. I'm the chairman of the Midwind Investment Trust, and I'm responsible for that. And I run the Library of Mistakes, which is a real room full of books for younger people listening. That's what a library is. And we have 3 of those in the world, and hopefully 3 more to come in the next 12 months.
The Keeper. And you have how many now libraries and how many different cities?
So we have 3. We have Edinburgh, we have Pune in India, we have Lausanne in Switzerland. We will probably have Singapore and probably have London. And as we're talking to 4 other countries, one of those randomly might also open, but I couldn't tell you which one. So that's what I'm hoping for the next 12 months. It is just a business and financial history library, but if we called it that, nobody would turn up.
Well, it's a brilliant concept. Helen, what about you?
I have no training in economics either, though I am an academic. My official title is Professor of Political Economy at Cambridge University in the Department of Politics and International Studies. So basically, I've spent 30 years trying to think about the relationship between the world economy and politics. And over the last probably now about a decade, I've been increasingly focused on energy because I came to the conclusion that you couldn't really understand the world economy or indeed the political implications of the world economy without looking through the lens of energy and seeing the centrality of energy to pretty much everything in our material lives. I published a book last year called Disorder, Hard Times in the 21st Century, which makes energy pretty central to the story that I'm telling about how we ended up with such a set of economic and political disruptions in the 2010s. And there's a paperback edition with a new chapter of that book coming out in October, I think. And I'm also the co-host of a new politics podcast called These Times. Quite a bit of it is British politics, but we're also interested in talking about geopolitics.
Yes, congratulations on that. I listened to it and I really enjoyed it. And I told you I'm a fan of Unheard as well. And I was actually listening to Freddie Sayers' latest conversation with a general talking about the potential for the use of a nuclear weapon in Russia before I came into this conversation today. What's the new chapter about? Can you tell us?
Yeah, basically, my book came out on literally the day that Russia invaded Ukraine on the 24th of February 2022. So the new chapter is basically the year of war. So trying to tell the story of last year of 2022, both as part of a continuum of the long history that I was telling in the original version of the book, but also trying to capture that as a rupture.
Wonderful. That's going to be a very interesting read. I look forward to it. And Eddie, what about you?
Well, I'm a third non-economist at the panel. I read history at Cambridge, Oxford, and then went to work for a merchant bank, Lazard's, on the corporate finance side, but got bored of that and started writing financial history, published a history of financial speculation in 1999 called Devil Take the Hindmost. I then went into writing more financial journalism, did a report on the credit boom called Crunch Time for Credit, which put out in 2005. After the financial crisis, I went to work for the investment firm GMO in Boston, where I spent 6 years. And then I left GMO in 2014 and went back to writing full-time, and last year published a history of interest called The Price of Time, The Real Story of Interest, which tries to make sense of the extraordinarily low interest rate period that we have up until last year been living through.
Yeah, I've read all of your books. I mean, I can't remember if Russell published another book before the book on the Asian financial crisis. And that was the first time you'd been on the show. A phenomenal book. It's actually I don't know if they're technically your diary entries, but it was your chronicling of the period of the Asian financial crisis from, I think, 96?
Yeah, it starts 96 through to 98. So it's the bit before, which is actually probably the most important bit, because how could you work out that it was going to happen, the crisis itself, because it was all a bit too late by that stage.
It was brilliant. I think you were in Hong Kong at the time, if I remember correctly.
Yeah, I was at Hong Kong. It was a dramatic time to be there, and the handover happened as well when I was there. So a second geopolitical act, which is the consequences of which are still echoing down the years.
Yeah, so that's what we're actually here to talk about. And I was telling all of you that I sketched out some forces, so to speak, that I think have been really consequential, particularly consequential over the last 40 years. And it's always difficult to try to find a starting point. It is always artificial. But I think maybe the best way to begin this, because I do envision this more as a conversation without necessarily too much structure. Maybe we can start with you, Russell. The question that I would like to ask all of you, but we can start with you and then we can kind of just work this out, is what are the most consequential social forces, and by social I mean political and economic, that have defined the world that we have lived in up until at least the pandemic? And the reason I ask this is because I think many of us are grappling with the question of whether or not that period has come to an end and we are entering something new. So I'll start with you, Russell, because you've explicitly dealt with this yourself in many instances, and we've talked about it on the show. How would you go about answering this question?
Well, first of all, thank you for asking me first. So I'll just say China, and it's how the impacts of China being integrated into the global economy And then on your second bit, is it over? And those two things are huge. So I was just looking around the room thinking, is there anything in this room that the price of which has not been impacted by the emergence of China? Interest, has it not been massively impacted by the emergence of China? Debt levels, it's just that, bringing that economy. And I was in when it started, really. So in 1992, the first Chinese stock was listed that was accessible to foreign investors. So I've watched the whole thing, and it progressed at a rate that nobody forecast. I can say that nobody forecast. And the crucial thing that I think nobody forecast was not that the labour couldn't be mobilised. It was a massive investment. It was the sheer scale of investment in tangible, productive facilities. That affected everything. It affected prices, obviously. It affected jobs. It affected wealth inequality. I'm talking globally, not just about China. And it led, in my opinion, and I put this in the second book, it led to the massive debt bubble as well, because China depressed the rate of inflation, but also depressed the rate of interest with its currency manipulation. And I think the world would have been very different, actually, if China had emerged without currency manipulation. But that was allowed to happen, and it has caused huge distortions. And it is over. It is over because China's not, its foreign exchange reserves are not going up. But more importantly, I'm sure we'll discuss it a lot, it's geopolitically, the conflict is there. It's got to such a stage. Well, it started in 2012. There are people here who know more about it than I do, but the pivot to Asia by Obama tipped China off that it wasn't going to be able to grow its sphere of influence. And that's when this restriction started. So really, I think since 2012, we had to live with a different world, and we're just living with the consequences of that. And I'll stop there. But if you want to talk about China and how it changed the world, that's about a 45-minute conversation just there. But that's the one I would pick. It's changed most things.
Was it Deng Xiaoping that introduced the hide and bide?
Yeah, there's a very good book on that.
That was Deng.
That was Deng
Xiaoping. Is it Rush Doshi's book has just come out on that, saying that's exactly the policy that was. But anyway, that Obama called that out. And every president since then has called that out. And certainly in my business, people have speculated that the next president would be more accommodative to China, but it doesn't seem to matter whether they're called Trump or Biden. They don't become less accommodative to China. It seems to be a structural situation, and the US isn't changing politically to go back to accommodating China.
So Russell mentioned interest. That's obviously the focus of your last book. And I think in both of our conversations, my conversation with you, Eddie, and Russell's, you quoted Jim Grant. And I think Jim Grant had said, if I'm remembering correctly, that interest is the universal price. And I bring that up because I think I don't want to take for granted people's understanding of economics and their sense of the dynamics of savings and capital flows and how it is exactly that Chinese savings and the rise of China has influenced interest rates. But whoever, whether it's you or Russell, whoever might want to explain that, or Helen, I'd love for you to maybe just explain your understanding of how this dynamic has impacted interest rates in the United States over the last several decades and why that might be reversing.
In the context of your earlier question of a major social force, I agree with what Russell's saying, and in particular his comments on how the entry of China into the global trading system and financial system had an impact on interest rates, bringing interest rates down. And we see that in earlier periods of globalization, for instance, in the second half of the 19th century. So globalization dampens inflationary pressures because you've got workers in other parts of the world who are prepared to do jobs for less money. And in a way, the interest, in a sort of Marxian way, the interest is a sort of congealed labor carried through time. So you have lower interest rates, but I don't think you would have had such low interest rates but for the help of our own central bankers who, as you all know, brought the interest rates down to zero and negative in some parts of the world, in Europe and Japan, after the global financial crisis. And then, in addition, trillions of dollars of quantitative easing of central bank security purchases. And I think that, and the thrust of my book, is that that has had extraordinarily profound consequences, both financial and social. On the financial side, I argue that the very low interest rates inflate asset price bubbles because the interest rate is a discount rate, the capitalization rate in which we value assets. So you get housing bubbles, cryptocurrency bubbles, bubbles in SPACs, bubbles in contemporary art, you name it. We get the everything bubble. But interest is also a measure of risk, an insurance premium on a loan. So you take interest down to very low levels. It's the equivalent of taking the insurance premiums down to very low levels. The system but builds up risk. People take risks that are not properly compensated. And obviously interest is the price of borrowing, the price of leverage. So you will find a build-up of leverage. So the upshot of that, and I think this is where we've been living through in the last year, and my book, just like Helen's book, came out on the advent of the Russia invasion of Ukraine. My book came out just as the Federal Reserve was beginning to raise interest rates. And then we've had umpteen interest rates over the last 15 months, I'd say. And we've seen cracks appear in the system. We saw global bond markets and stock markets sold off last year, but we've had more specific problems. You see the UK pension funds nearly collapsed. The UK gilt markets, the index-linked bonds fell 85%. You've seen a regional banking crisis in the US. And even this week, Russell, you probably observed that Thames Water, a highly leveraged, highly financialized company, is on the ropes. And go back to Jim Grant's comment that interest is the universal price, that interest gets into all the cracks, that as we move to higher rates, then cracks are appearing here and there. On the social side, and this is what I think the policymakers, they haven't understood any of the stuff I've been talking about, but what they really are blind to is the social consequences of the ultra-low interest rates. I argue that the very low interest rates actually diminish the Schumpeterian creative, destruction forces in an economy, and therefore contribute, and they lead to the misallocation of capital. And put that together, they contribute to low productivity growth and low income growth. At the same time, these wealth bubbles benefit those who either possess wealth to begin with, typically, obviously, people who are rich start with, or older generation, and they disadvantage younger generation and people who don't own assets. So if you put that together, low income growth and rising inequality on the back of asset price inflation, you then get a rising discontent with a market-based system, an idea that the system is fixed, that against people. And I think that to some extent contributes, or to a large extent contributes to social discontent. Throw in Russell's comment that China has had a huge impact. And Russell has a friend called Stuart Patterson, who wrote a very good book called China, Trade and Power, about the impact of China joining the World Trade Organization in 2001, gaming the system in order to suck jobs from the West into China. And of course, the large companies, large multinationals, supporting and in fact actually financing the deindustrialization of their own countries in order to boost their profits in the short term. So you put those two things together and you can see, to me, it seems obvious where those sources of discontent, or what are dismissively called populism, come from.
So one observation, then I want to move to Helen. I think also when you're talking about interest rates and the rising wealth disparity, and you talked about the UK gilt market, real estate in the UK is extremely expensive, and it's been facilitated by secularly low interest rates. And now with interest rates rising, it's not clear how that's going to be resolved here, which also brings up dirigist policies potentially. Yeah,
so I mean, I'll give you, so the UK house price to income ratio went from around 4 times at the turn of the century to over 9 times. And debt levels have gone slightly higher. The increase in debt, household debt, mortgage debt to income has gone, I think, up to about 3.6 times. And the point, and many households will have much, much higher debt, people who bought in the last few years. And that creates an acute vulnerability to rising interest rates, particularly in the UK, because the British borrow off short-term rates, or they have short-term fixes that convert into floating. So unlike the Americans, we have extreme sensitivity.
Most of the 2 or 5 year mortgages, right?
2 years I think, so as I understand, Russell, probably 2-year fix, then switching to floating is the standard. And the 2-year fix is now at over 6%. According to a housing analyst I read last year, that 6% rate is the equivalent rate. It is consuming as much of household income as the rates of the high interest rates in 1989 at the end of the Lawson boom. And at the end of the Lawson boom, we then had severe house price crash with millions of households in negative equity. So yes, and one of the corollaries of these very low rates and these very rising high asset prices is that people didn't save. They just sat in a house, Cambridge or London or wherever, and thought that they were very clever because the house was going up in value. But now that free lunch has come to an end, I'd say.
So I do want to continue exploring the consequences of the recent rise in interest rates because there are a lot of interesting avenues to explore there. But I do want to ask you something, Helen, because you've been sitting there patiently. And you don't just write about energy in the book, but energy is a big part of your framework. And without cheap and available energy, we would have much higher prices. And with much higher prices, we would have a more difficult time keeping interest rates as low as they have been. And I'm curious, from your perspective, from the way that you look at the world and the work that you've done, how do you see the rise of China and the importance of China in the world that we live in today and in this period of transition, if that's in fact what we're going through?
I think that what the rise of China does, in the ways in which Russell was talking about it, is bring the story of the 70s crisis and how we got out of the 70s crisis in the West to an end. So if the 70s is a decade of energy shocks and the beginnings of what we might call the financially liberalized world, or a hyper-financially liberalized world anyway, is that looked like a decade of crisis in which Western countries were stuck, not least the United States, which had moved in that decade from being just about still domestically self-sufficient in oil to being pretty much the largest oil importer in the world by the end of the decade. And what we can see in the 80s is that a combination of stalled development in countries that had looked like they were developing more rapidly at the beginning of the 70s, plus new offshore oil, particularly in North Sea, Alaska, but also Mexico, and very conveniently from Western countries not being in the Middle East, got us to a point by the middle of the 80s, the latter part of the 80s, where inflation wasn't really a problem any longer. And I'd say it was probably quite useful from Western countries' point of view anyway, that China under Deng Xiaoping marched down the development road that it did, hand in hand with its one-child policy that Deng Xiaoping thought those two things went together. So if we then spin on to the early 2000s and China's integration into the World Trade Organization that allows China's growth to be, really considerably higher. China's demand for energy goes up with it. China's demand for oil goes up. It doesn't go up actually as spectacularly as its demand for coal, but it goes up significantly enough to bring the oil problem back into play. And it goes up at just the time when actually the world's oil production is basically stagnating, which is around 2005. So you've got China driving Asian demand up at the same time the world's supply isn't adjusting to that. So I think then we've been in a kind of energy situation, let's call it just an oil situation for the time being, pretty much from that point on. And interestingly, and this does actually tie to the interest rate question, the way out of that in the 2010s is the shale oil boom in the United States, this rapid increase in US production. It's only because of that shale oil boom that the world economy gets through 2010s without an energy crisis. And what you can say is that the condition for that is really monetary and financial, in the sense it's the very low interest rate, quantitative easing, monetary and financial environment that makes it possible for a lot.
Helen, so I'm just give an aside on the fracking, is that there was the huge investment in fracking in the 2010s, driven by the low interest rates, particularly financed with high-yield bonds. And those high-yield bonds were picked up by people hungry for yield. But in the end, the frackers proved to be unviable. So we got an increase in supply, but actually no returns from the investment. And so it's sort of quite curious that that's come to an end. As far as
It
I
is,
see.
but I think the thing to understand here is it's the very dysfunctionality of the monetary and financial environment in the 2010s that actually makes it possible to get out of the energy, or I should just not call it the energy crisis, oil crisis, that I think is in play by 2005, 2008. It would not have been possible to accommodate China's high demand, and it isn't actually just China's, it's India's too, without the shale boom. And it wouldn't be possible to have the shale boom, as we've both been agreeing, without the dysfunctional monetary and financial environment. And if you say then, well, how have things changed now, is that the monetary and financial environment has changed because we're back into an era not of high interest rates, but higher interest rates. And at the same time is the shale boom can no longer grow at the rate in which it did do the 2010s. The shale boom is pretty much down to the Permian Basin. And that means that actually we are in a period, even leaving aside the issue of the war and the energy shock that delivered to European countries in particular, we're in a structurally different set of energy conditions than we were even 5 or 6 years ago. So we've now got tighter energy conditions allied to a more difficult monetary and financial environment.
So how established or how sure are we that the shale boom is over?
No, the shale boom is not over. The shale boom is going to continue for some time.
Or at the current cost of procuring more.
I think that what we're seeing, though, is the concentration of the shale boom into the Permian Basin. So the other big plays, Bakken and Eagle Ford, probably reached their peak maybe in 2015. It might not. I mean, it's always difficult to tell those things. I mean, if you look at what the International Energy Agency is saying, it's still expecting that the growth in supply over the next few years, so to, I think it's till 2028, is going to come primarily from Permian plus Guyana and Brazil. So there's still life in the shale boom, but it cannot grow at the same rate in which it did in the 2010s.
Yeah.
And so at that point, the fact that production is stagnant elsewhere, conventional production is stagnant, matters unless there's a pretty significant reduction in demand for oil over the next 5-10 years.
So that leads us perfectly into where I wanted to go next, with the next question I wanted to ask you, which has to do with the search for renewable sources of energy, non-carbon based. Now, again, in your book, you talk, a big part of your book is devoted to this revolution or this rotation out of coal into oil and how that affected geopolitics and economics. So you're talking about now how the demand from China caused an increase in the price of oil and gas. And the question is, can renewable energy, so everyone has this, I think there's a line of thinking, a narrative that there's been chronic underinvestment in the oil and gas space and that prices are inevitably going to rise. But I wonder if the Chinese, who are building many nuclear power plants, who are investing in battery technology, could we end up in a situation where these renewable sources of energy actually supplement the needs of the world enough so that the combination of that and the legacy fuel sources are enough to keep the price of oil for a substantial period of time at roughly where it is today?
I think some of these questions are, very hard to answer, basically, Dimitri, because at the center of them is the problem of time. And what we are in, it seems to me, is a situation where we're doing the energy transition. We're moving to low carbon energy. We're going at relatively slow speed, at least outside the decarbonisation of electricity itself. So if you say how much actual oil demand is being replaced, essentially by using electricity instead of oil, not least in transportation, the answer is nowhere near as much as people would hope to be.
And also doesn't solve the problem of chemical.
No, it doesn't solve the petrochemical problem,
exactly.
because demand for petrochemicals is still rising quite sharply. But at the same time is that oil is its own problem, if you see what I mean, in the sense that this supply problem that's been there since the first decade of this century, but was compensated for by the shale boom, that has got a shelf life too. And unless something radically changes in terms of either new discoveries or new investment in the bigger discoveries of the last few years. So the question is in a way, avoiding energy crises in the future is can we speed up the move away from oil? And does that happen before the oil constraints really start to bite even more than they are at the moment? Because at the moment, I think that the oil problem is being masked by the weakness of China. Now, you might argue that that's going to continue, so that China's weak demand, that if China's now actually can't expect to grow at anything like the rates that it had done, even say in the 2010s, then actually we might just carry on in this position that we are with oil prices for some time. But if China were to start to grow more rapidly again, that changes. And then there's also the question of India, where probably the demand for oil is going to rise faster in India than anywhere else. So then the speed at which it rises in India really comes to the fore.
I'll just reverse engineer that and say, if we have to do all that investment, what is the cost of capital that can deliver it? If it isn't the existing cost of capital, the government's going to have to rig the cost of capital for that particular increase in renewable energy. So it's kind of, obviously it feeds into the financial repression story. But the idea that the market will be allowed to determine renewable supply and investment, the government is already massively intervening to give a false cost of capital, and it will continue to do so for a long time to come. So if you reverse engineer the need for that, you end up back with government-directed flows of capital if the market can't deliver it.
Just in the last decade, the ultra-low rates also affected the investment in alternatives. There was cheap financing for alternative energies, for solar and wind turbines. It's not clear whether, if you put up interest rates, that a lot of these projects are viable. But I think the most important question I agree with Helen's point about the absence of lack of investment in oil and the potential constraints. But the most important question, as far as I see it from a big historical perspective, is each of the industrial revolution, each of our energy transitions has happened without any direction by government. It's because each new successive form of energy is more efficient on an energy return on energy investment. And from that comes the productivity growth. So if we had available now a source of energy that was more cheaper to produce and produced a greater surplus for mankind, you wouldn't need the government to involve itself at all.
Well, you say that, but it's about the externalities, isn't it, and the impact on the climate, and those are not priced in by the market, and that's why I'm not saying that.
I know, you could argue that our 300 years of economic growth has been one in which the externalities were not incorporated. Fair enough, but the point is that, have we taken on board the consequences of shifting to a lower form of energy efficiency? Because I think then, you get, if you transition without considering what the consequences are, we at the moment, we have this idea that creating a huge amount of jobs, blah, 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 from an energy transition. The reality, I would have thought, is going to be less surplus for mankind, and that less surplus for mankind meant less energy surplus for mankind, given this current state of technology, and that throws up a huge number of problems.
I think it's also true, though, that European states in particular did actually play quite an active part in the beginnings of the age of oil, if we're going to call it that, because the first thing that oil was being used for in a way which had geopolitical implications was navies, oil-fueled navies. And European governments, not least the British government,
right,
actually,
exactly,
you could say the British government was obsessed, actually, with using the power of the British state, indeed the British Empire, in order to put Britain in a position where
Churchill?
Where it could transition to an oil-fueled navy. I think you can say that the relationship between the development of oil in the United States, where obviously it was there in domestic abundance, and the American government is different, but pretty much all the European governments.
But Helen, go back earlier, say, to coal. You're aware that the coal was in, and the canal system, and then the invention of steam technology to help move coal. This was all, in effect, funded by private investors on the energy gains that came from coal and superiority over
But we're talking
would.
about something completely different now, because the world has decided that this is not an economic issue. It's a climate issue. And therefore, economics by itself is not going to answer. I'm not saying that's my opinion, but that's clearly the opinion of governments. And if Helen's right, we have to massively increase supply. It's going to be done with a false cost of capital, because we can't afford the slow pace. Politicians can't afford the slow pace done at the existing cost of capital, so they will make one up. And that's happened throughout history as well. Now, maybe not happened in the energy business, but there's lots of businesses the governments have decided they need to be strategically in over the years. And this is the one that they need to be strategically in. So to me, if the market doesn't deliver it, I don't think the market will deliver this time, because it's not about energy, it's about emissions. Then the government feels a carte blanche to intervene.
So you mentioned the climate. That's sort of been climate has driven, I think, investment in the space, but it seems that also now the geostrategic importance of resiliency and self-sufficiency is a huge driver, especially in the case of China. And that raises additional questions of how, I don't know in the case of oil how much innovation and technology was shared around the world as a result of capital investment in the space. In other words, what were the economies of scale that derive from the investment in oil and gas versus now with this world that we're moving into where there's more hostility and we're seeing less cooperation. I'm curious if you've thought through at all what that would mean for progress if the Chinese are sort of going off on their own trying to secure supply chains and in the raw materials that they need and the accompanying technologies to produce renewable sources of energy. Do we have a less efficient move in this direction?
Well, I think the crucial thing to understand here, and it goes back to something like Russell said earlier, that China's advantages across the board where low carbon energy is concerned, not least not necessarily always the extraction of metals, but the processing, supply chains around the processing of metals, is partly why we live in the geopolitical world in which we do. So I agree that there's a shift in the US in 2012 with the pivot to Asia. But I think the more important shift comes actually in Washington in 2015, when Made in China 2025 is published by the Chinese leadership, because that shows very clearly that the Chinese leadership are thinking in terms of a low carbon energy world being one that China could geopolitically dominate in energy terms, and wanting to actively create dependencies of other states, including the United States, on supply chains that China dominates. And you can see that in terms of, let's just say, the manufacturing of solar panels, not just the metals question. So the question of geopolitical competition in this move towards low carbon energy is already baked into the very nature of it. And it's shaping, I think, it's driving part of the geopolitical rivalry between China and the US. And it's part of the reason why the American politicians are no longer willing to accept that the world that they created in the 90s and the first part of the 2000s. Now, you can try to be optimistic about it and say, well, actually, that this intense competition will lead to like technological innovation, and in the end everybody will benefit from that technological innovation. But if you look at the history of oil in particular, you wouldn't really get to that conclusion. What you would suggest is what you would get from that history is that geopolitical conflicts and tensions over resources where energy is concerned lead actually to quite dramatic conflict between states.
I think what's fascinating about that is, what does it mean for Europe?
You read my mind. That was my next question, which is because in Europe, the distributional costs of this transition, I think, have been felt more acutely, certainly than in the United States. So, what does that mean? And what does that mean for the ruling legitimacy of governments? I mean, again, Europe is a really case in point, because you also have the supranational structure of the EU that has created a lot of discontent in local sort of national politics.
Well, I think you can see that Europe has a very big problem, and that is, well, it actually has a set of big problems. The first of them is that in metals terms, it's in a pretty bad position. And I don't just mean now in terms of the existing supply chains, I mean in terms of the geographical distribution of like metals, of the metals in the world that are necessary for low carbon energy. They tend to be more concentrated in the southern hemisphere. Those that are in the northern hemisphere are more in the United States and Russia than they are in Europe. So in that sense, if Europe's been resource poor ever since the age of oil began, then the switch to low carbon energy depending on certain metals doesn't change that. And Europe's also then got to try and play catch up with China in a world in which the United States is playing catch up with China, hence the Inflation Reduction Act. And the United States has all kinds of advantages in that competition that Europe doesn't have, including the fact that the European Union, if we leave out the individual European countries, has got to have some kind of collective decision-making process that can deal with the rather different energy interests that the individual member states of the European Union have. And they've now got to deal with that in a world in which they've experienced a severe energy shock, the partial, at least, breakup of the long-standing energy relationship with resource-rich Russia because of Russia's invasion of Ukraine. That also happened on top of the shock that shale gas in particular represented, because American industrial companies have got a lot cheaper supply of gas than European countries had. And that was true, actually, significantly true before actually Russia's invasion, but now it's even more true because European countries are left importing more expensive liquid natural.
I think there's been a couple of really important speeches on Europe, one by Christine Lagarde, one by President Macron in the last 2 months. The Bratislava speech, where he went to see the Visegrad Four and proclaimed that they would no longer be dictated to by Brussels or any other capital city of Europe, which is rather different from what the Jupiter King has said in the past about the direction for Europe. I think that's a sea change. Jean Monnet's famous quote that Europe would be forged in crisis, and it has been true. It comes more to the centre, power comes more to the centre of each crisis. But here's Macron admitting what I think is obvious, that there is a certain amount of disagreement as to where Europe goes, and power is going back towards these countries, and the ones that I think he's historically called them the illiberal states. Now he's saying, get on with it. That's the big thing. And the second one, I thought, and particularly in the context of your book, really important, Lagarde's speech in New York on the 17th of April, where she said, there's a threat to the euro as a reserve currency. And my job is to advise financial investors. Not one of them ever asked me about the threat to the euro as reserve currency. They just asked me about the threat to the dollar as a reserve currency. The fact that the central bank raises it, it's a training as a lawyer. You should never raise these questions if nobody's asking them. And they followed it up last week and said, if we use the sequestered Russian assets to rebuild Ukraine, it will undermine the euro as a reserve currency. So there's some huge structural issues being raised for Europe. Because it's so obvious there's a clash between China and America, I think we're not really focusing enough. And at least two of the most senior people who are running Europe, head of the central bank and President Macron, seem to realise that there's a shift underway and that Europe's very vulnerable to it.
Yeah, we haven't even begun to discuss the role of sovereign debt in Europe, which has been an ongoing problem since the 2008 financial crisis. And the political disunity on the continent makes it more difficult to solve that on a supranational level. You have very challenging demographics in Europe as well. And then you add to that the energy problems. What do you see as the future for Europe? One, does it have, at this point, any talk by Macron and others about strategic autonomy in Europe is probably out the window. They're going to have to.
He did say that actually in Bratislava. He said that, we're basically defended by NATO. For a while there, he said there would be a European defence force. But what he said in Bratislava is, we're defended by NATO. And we all know what NATO is. It's America. So he has conceded that Europe is not a third force. And that's part of Lagarde's fear for the euro as a reserve currency, because it's so clearly part of the dollar bloc now. So I think Europe's conceding it. And the weakness of Germany, the strategic errors in Germany, the political division in Germany only makes it more likely that Europe has to fold into the US bloc and is not a third force. I don't know if everybody else agrees with that or not, but that's what I think these speeches recognised, that where Europe is.
I think we're going to see considerable resistance, or at least attempted resistance, inside Germany on the China part of this, because clearly German companies have had for a long time a rather different relationship to China than companies of any other European country, particularly the car makers, but not only obviously the car makers. Now, in one sense, that makes them particularly exposed. If you look at what's going on with electric vehicles, then Chinese companies are doing very well. Their export potential is clearly pretty significant. But on the other hand, for German companies and then German politicians, particularly perhaps those in the Social Democratic Party, or at least that party in terms of the governing coalition in Germany at the moment, to say, okay, we're going to de-risk, let alone decouple from China. That's such a big change to the status quo. That is such a disruptive thing, I think, for the German economy in terms of where the German economy is right now. Now, I think if you go back to prior to the pandemic, you can actually see that China was in one sense like fractionalizing the European Union economically. And you can see when Merkel in her last months in office was working with Macron to push through signing that investment agreement with China, actually, although they got the agreement made, then the European Parliament made it clear not that long afterwards that it wasn't going to ratify this agreement. And that was partly because there wasn't sufficient support amongst non-Franco-German member states of the European Union in order to do that. So on top of the fact of having to choose, and as Russell says, is all the structural forces actually lie in the direction of the American way rather than China's way, they've still got to deal with it as a collective, and they've got to deal with it with one state, which happens to be the largest member state in the European Union, having a rather different set of economic interests in relation to China than the others.
So are they just politically strong enough? I mean, so the left fractured a long time ago because the Greens rose, so the left fractured into, and now we've got the AfD. So the right's now fractured. So my thing is, it's very good to say this is what the Germans might want to do, but it's such a weak coalition, and they're going to have weak coalition after weak coalition after weak coalition, aren't they? So Germany was always reluctant to lead, but it's now unfit to lead because of the splintering of its domestic. I mean, the AfD's just the second biggest party in Germany now, if you believe the polls. And is it strong enough to take these positions and push back against America?
And its political strength would always derive from its strong economy. That was the core selling proposition of the political economy organization of Europe. So I'm going to move us to the second hour of this conversation, and I want to get it more into this idea of decoupling or deglobalization or reglobalization, because globalization has been one of the most dominant economic forces in the world over the last 30 years. Not only has it contributed to interest rates, but it's also contributed to innovation. It's contributed to economies of scale throughout the world. And also it's contributed in some sense to more political stability, where it's been a feedback loop. And I also am very curious to think more deeply about how political economies in the West will be organized. Are they going to end up becoming more centralized? Is there going to be a bigger role for government? And then what does that also mean for investors? What does that mean for capital allocation? And I think one of the challenges that I think about often is not just in terms of like something that Russell has said. In fact, I'm sure you've actually commented on both of these, which is not just, how to be perhaps invested in industries that government will incentivize capital movement towards, but also how do you avoid being invested in economies that end up being sanctioned or where capital controls are instituted that would limit your ability to gain access to that capital. So those are just a few of the topics that I'd like to explore in the second hour, guys. For anyone new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second hour of today's conversation with Eddie, Russell, and Helen, head over to hiddenforces.io/subscribe and sign up to one of our 3 content tiers. All subscribers gain access to our premium feed, which you can use to listen to the rest of today's conversation on your mobile device using your favorite podcast app, just like you're listening to this episode right now. Guys, stick around. We're going to move the rest of our conversation onto the premium feed. If you want to listen in on the rest of today's conversation, head over to hiddenforces.io/subscribe and join our premium feed. If you want to join in on the conversation and become a member of the Hidden Forces Genius community, you can also do that through our subscriber page. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. You can follow me on Twitter at Kofinas, and you can email me at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.